Hello, folks. We are in the final installment for the what every new and/or aspiring forex trader wants to know review of the last 4 years or so. I'm really condensed a lot of material, and it's not intended to replace going through all the old material, but it's just simply a means for me to get you back up to speed with the core essential tenets to what I use when I do my trading, my analysis concepts, and how I arrive at the ideas about the marketplace, and what framework I utilize to arrive at that opinion. Before we go into the material for this final stage of the presentations, it's important to understand that um, this is obviously a much of an abbreviated form of study. Obviously, each one of the components that I deal with here, and some of the things I've left out, like Trader's Trinity and like the ORO pattern and the Stinger patterns, all that are unique to me and my material. I left those out for a reason because I think the majority of the participants and members of our community, the Inner Circle Trader community, they have been exposed to a lot of information. And because I've been involved with trading for 20 years, I have a lot of tools in my repertoire. But not every tool is applicable to every trader. And I'm cognizant of that, and much more so now because of the large degree of feedback I've received from the participants in the study of my material. I am guilty of wanting to share everything and sometimes much faster, even though it doesn't seem like it's going fast for a lot of you. Um, it takes a lot of time to digest this material, and it's foolish to think just simply having a video or two, watching it, and then suddenly sitting in front of your charts, you're just going to be a maven and just go in there and start taking out pips and and just ruling the markets. And that's not how it works. You have to have certain tools and applications that resonate very close to your own uh, persona and your psyche as a trader. And what I did was is I went back to the core roots of all of my success, and it just simply goes back to support and resistance, understanding macro fundamental driven trends, which are higher time frame based only. That's monthly, weekly, daily. And by having that as your foundation, a lot of the shorter term time frame analysis concepts will be much more uh, accurate, much more sensitive to your needs as a trader, and understanding what it is that you are trying to accomplish as a trader. The previous sessions, we've obviously went through a large degree of material pertaining to directional premise, because I think if there's any one question I get more sent to me by way of Twitter or emails, it's how do I know which direction the market's going to go today? And while I'm not 100% accurate every single day, my tools guide me in a manner where I'm in the upper 90% bracket in terms of directional premise. And there's no mystery as to why that is. It's simply because I'm disciplined enough and I trust the tools to allow the adherence to a certain frame of mind going into the study of price. The higher time frame trends tend to stay in one direction or another for a long period of time. There may be minor corrections or pauses in between, but generally the macro major trends, or tides if you will, those waters tend to keep moving in the same direction for a long period of time until they hit a greater or equal resistance in terms of their support or resistance, or geopolitical or economic front changes because of something large scale, war or something like that comes out. The concepts that we're going to be discussing in this last one will be a little bit of combining all the stuff together, and a couple other points that I didn't bring up earlier but are going to be much more paramount now, because we're going to be doing a lot more of the execution stage of all the tools. And the first we're going to talk about is risk on or risk off. And if you don't know what that is, obviously, in a risk on environment, that's typically when you see equities, stocks, and such, commodities, and higher yielding currencies, okay, they will tend to rally or move higher up in price, while the dollar generally will be moving down, okay, because it's commonly viewed, and I hate to say it like this because the dollar has been beaten up over the last couple decades, really, because it's really fallen out of favor in terms of a lot of the global uh, countries. They don't really have a lot of faith in the United States and our economy, and I think it's justified in a lot of ways. But as it is right now, the greenback still is the reserve currency. It may not be that way for very long, but it is at the time of this recording in 2014. If we are expecting firmer prices in the dollar, that would equate to a risk off scenario. And that would translate in the form of lower equity or stock prices, lower higher yielding foreign currencies, and commodity prices dropping. Okay. And you don't have to go crazy and have every single commodity and every single stock up and every single indice, okay, for stock index. You just need a few, and that will give you a clear depiction every single day with the accompaniment of the US dollar, obviously. And what we're showing here is a US dollar daily chart. And if you're familiar with a lot of my market reviews or my commentary, I generally have this most often, very first thing I talk about is the dollar, because it is like my barometer. It tells me, are we in a trending environment? Are we in a consolidation environment? Are we in a risk on or risk off environment? There's a lot of information that is derived by this simply understanding the dollar. And especially because I trade the majors in Forex, it's going to be paramount in my understanding of where price is most likely going to go today, if not for the next few days or even several months out, depending upon the level of trader you're going to be. If you're going to be a long-term position trader, short-term trader, swing trader, or day trader, scalper, it doesn't make sense not to at least reference the higher time frame dollar and higher time frame currency pairs that you are intending to trade. Okay, having that macro view is essential, in my opinion, to having longevity as a trader, and obviously the what everybody wants, which is high accuracy and um, directional premise. Okay, and there's a lot of weight placed on directional premise for new traders, and I get it. I did the same thing. I just wanted to know, okay, is it going to go up or is it going to go down? And you have all heard the story. I understood the market only going up when I first started. Never understood that you could make money going down. But in the currency markets, obviously, because we are focusing pretty much on the foreign exchange or forex markets in this series, the things that I'm discussing here um, are pretty much universal. They apply to every asset class that is tradable. Okay, and you can use these ideas in those other asset classes in your trading. There are a few things that are sensitive to the cable, which is the British pound USD pair, and the fiber, which is the Euro USD pair. Some of them are time of day, and while the London session, which is, again, I'm going to refer to times in my own local time zone. So you'll have to translate that for where you are in relation to me around the globe, because it's too difficult for me to keep track of all you guys out there and try to figure out what you should be setting your charts up for and what time it would be, you know, in respect to what I'm viewing. Okay, so when I say 2 o'clock in the morning and 4 o'clock in the morning, okay, that's like the sweet spot ICT kill zone for the London Open. Now, obviously, it could start an hour before that, or it could last as long as 5 a.m. New York time. Again, this is all New York standard, my local United States, North America, East Coast time. Okay, so the easiest way to do it is set a clock, get yourself a little, desktop application you can put on your computer. Smartphones, you can put a world clock on. I have every world clock for the Asian session, the Sydney session, the um, Frankfurt session. I have all the major time zone on my world clock on my iPhone, and I just look at certain times of the day when certain moves take place, and you can do that same thing by just simply saying, okay, look, this is ICT zone. Okay, this is what Michael's viewing in terms of price action. You don't have to continue doing that for years from now. Okay, obviously, if you're trying to learn my understanding of the marketplace and my concepts, it'll be a lot easier for you to just get in sync with me because I'm on New York time. So everything that I view the marketplace as in reference to time will be hinged upon what time is it in New York. I live in Maryland, but I'm in the time zone that New York is um, viewed as. So now let's talk about risk on and risk off. Okay, assume for a moment that when we discuss risk on scenarios, that would be indicative of price action like this. Okay, when risk on is in the marketplace, okay, you'll see the dollar falling. Okay, when the dollar rallies, anytime the price of the dollar is rallying up, depending upon what time frame you're referring to, obviously this is a daily chart, this would be a swing, okay, in between this low and this high. This would be classified as a risk off scenario. Okay, risk off would be the dollar rallying. Now, when this occurs, okay, imagine a children's playground apparatus. Okay, we probably all rode one as a child. One child gets on one end of the seesaw and another child gets on the other end of the seesaw. Okay, and what will happen is the two children will press off the ground and make the other one rise up, and back and forth goes on. Well, that same teetering effect, okay, it's like a scale as well. If the dollar goes up, foreign currencies go down. Okay, if the dollar goes down, foreign currencies go up. It's very, very simple, but many times new traders that are first introduced to risk on, risk off, they overcomplicate it and they try to make it more than it really is. But the easiest way to understand it is if the dollar's going up, everything else, whether it be equities, whether it be foreign currencies, commodities, okay, those will be going the opposite direction. Okay, and the easiest way to understand it is risk on is when dollar goes down. Okay, and that's basically a flight from the dollar into a higher yield seeking asset class. Okay, because it's viewed as more risky and the dollar is a safe haven, and I say that with tongue in cheek. Obviously, I know most of you are thinking the same thing I do. The dollar is nowhere near the degree of a benchmark like it used to be, but as it were, if the dollar is going up, okay, that's going to be a risk off scenario, and it's going to equate to seeing lower stock prices, commodity prices will be declining, and foreign currencies will be declining. Okay, so there's going to be a vice versa effect. And that's the reason why I study the dollar first, because it will give me the beginning point or foundation for understanding where the marketplace as a whole should go. Okay, now is it right to the minute every time? No. Okay, but again, that's the benefit of using these higher time frame charts, monthly, weekly, daily, is because those trends, those macro trends, they tend to exist for a long period of time, and it takes something with a real large impact on price to cause it to stop, pause, or even altogether reverse. Okay, so I'm trying to teach you the understanding of trusting the higher time frame premise, especially when you're looking at macro trends. Macro trends are going to be arrived at by looking at higher time frame charts and looking at asset class to uh, uh, indice or dollar-based correlations. In other words, if you're a stock trader, obviously, you know, if you trade New York or if you trade American stocks, your benchmark would be obviously the Dow 30, the S&P 500, or the NASDAQ 100 Composite Index. Okay, and by looking at those three indices as a whole, okay, and applying such things as Dow theory, if you're looking at a marketplace that is poised to go higher in the indices, that's pretty much that's a good time to be buying a stock. Well, the same thing happens by looking at the dollar, but you have to invert it. Okay, so if the dollar is poised to rally, okay, it's important that you understand that if you start looking to buy foreign currencies, okay, you're trading, okay, against the undertone of an adverse market environment. In other words, you're going to be trading at the lowest probability for that move to occur, because the dollar, if it's poised to go higher, what does that translate to in foreign currencies? Lower foreign currency prices. Okay, so let's look at an example, and I actually have some notes on this chart, as it were, because I did a live session here about a week ago, and I made some comments about where I think the dollar was going to go and the behavior I expected. And some of you that were in the live session obviously will recognize these lines and what I was doing. But this level here, okay, this is a resistance level. Price was unable to break above that, and I was using a lot of the wicks and the bodies of the candles as reference points. Okay, so I used the two bodies of the candles and the wicks. Looking at this level here, we broke through it a week ago and midweek, and then came back down on the previous week's Friday. And I was noting these levels here, this level and this level. So if we broke through and came back down, it would most likely find some support here or find some support here. As that's the reason why we have this little thing here I drew. So let's get this off because it's probably confusing you. Okay, and this line here is just to represent if these two levels give way, we would come back down to this level and expect some sort of support to come underway. Now, when price comes back down to this level, even though it sweeps below it previous Friday, look where it closes. It closes right at that same level. And then on Sunday, we had an unchanged event. We had a little bit of movement, try to push above it again here on Monday. And then Tuesday, we had the rally. And then now here it is today, Wednesday. Price has now started to recede, but it did trade higher. This environment right here, where price comes down to an expected level of support, your mind should be thinking, okay, we're in a move that's been going higher. Okay, we broke a resistance. This may act as support. So again, what's that translate for risk on, risk off? Well, if we think if price comes to this level here and bounces higher, okay, that's implying that we're going to expect the US dollar to rally. That is going to be what? Risk on or risk off? It's going to be risk off, because when there's less risk taking to be made in an environment of speculation, the dollar will be bought. Okay, there's going to be a flight to quality. Okay, that's what I'm not. Don't argue with me, guys. That's just the way it's called. Okay, so whether you want to refer to the dollar as being quality aspect or not, that's what it is. So, a flight to quality sees firmer prices in the dollar, and that will translate to a lower move or sell signals, if you will, in the foreign currencies. Now, again, because I trade the majors, that's the British pound USD, the Euro USD. Once in a while, I'll trade Canadian dollar or Aussie dollar. Okay, but generally I'll trade, just the fiber and cable. But now understanding the relationship to this, when we come down to a support level like this, that means on Friday, when we traded back down to that level, from Friday, Sunday, Monday, Tuesday, okay, in that area, okay, what we're looking for is sell scenarios to occur in fiber and cable. Okay, so again, to reiterate this, we're looking at the price that was above it on Thursday, the week before this recording. Price comes down on Friday, trades through it, but then comes right back to it and closes. Okay, so as early as Friday of last week, and or basically August 1st of 2014 is what we're actually going to refer to as the date. Then Sunday's opening, and then Monday's trading, and then Tuesday's trading, and then today's Wednesday's trading. Okay, and the time of this recording is the 6th of August, and let's take a look at what that looks like in reference to the cable. We're going to zoom in and make you really understand what's going on and how to incorporate this information. Okay, so this is Wednesday's trading. This is the daily chart of the British pound USD. This is Tuesday's trading, Monday's trading, Sunday's trading, Friday's trading. Okay, so in here we have price. Let me draw a little line here. Okay, right in here, this level, good grief, work with me here. Okay, Wednesday, Tuesday, Monday, Sunday, Friday. Okay, right in here, this down move right in here correlates with the previous week. Okay, the previous week in the dollar right here, when price came down right in here, that began the hunting ground, if you will, to start looking for sell scenarios in the cable and fiber and other currencies as well. Any foreign currency, okay, against the dollar, if it's front currency, for instance, again, let's go back to the cable. Look up here, get the British pound USD. If we're expecting the USD or dollar to rally, okay, if the currency is before the USD in the pairing, okay, like in this case for this major, the British pound should do what? It should decline. If the dollar's going to go up, the British pound's going to drop. So if the front currency, in this case is the British pound, you're going to see selling pressure if the dollar finds some support here, okay? Now, what we're going to do is we're going to zoom in on this day, and we're going to look at the relationship between the two, okay? And we're going to really judge with the X-ray view, is there really risk on, risk off scenarios underway, okay? And now I'll explain it as we get to it. Let's go over to a 15-minute time frame, and we'll zoom out a little bit more than that. And let's take this scroll off because it's gonna mess with me. All right, so here we have price trading lower, and let's take these. This is Sunday's trading in here. This is previous week's Friday, and this is the new week Monday. Okay, so we have that in reference, so we can take this off now. In here, this down move in here, this sell signal, look what happens. You have a high, a low, and a rally up. Okay, in here, this is how we look for the patterns. When the scenario is poised to unfold with firmer dollar, we should see weaker prices in cable. Okay, or in this case, British pound USD. When we have that environment, what we start to do is we apply specifics like time of day. Okay, and here is the beginning of that day. This is 0 GMT. This candle's high right in here is 8 GMT, and 8:15 GMT is actually the highest one right in here. That's 8:15 GMT. That is what I teach is the ICT London Open kill zone. Okay, now kill zone is a pocket of time, typically about 3 hours long. London's a little bit wider because this is a lot of activity going on. It's a lot of overlay from previous days. Trading from New York going into Asia, there's a lot of highs and lows that have to be retraced into, many times blown out during Frankfurt or early London Open. And that'll usually cause the daily high or low to form. Now in this case, obviously the high is a little bit earlier during the Asian session, but nonetheless we have a very tradable high at the key time frame of the ICT London Open kill zone. Now again, my charts here are GMT obviously, but 7 GMT, which is equivalent to like 2 a.m. my time in New York, and 9 GMT is like 4 a.m. my time. So between 7 and 9 GMT, that's typically where your high or low during London really forms. Okay, so if you really bracket out that much time over a long sample size of data, you're going to see that multiple times per week, you're going to see that the high or low for that particular day will occur between those specific time posts, if you will. So if you start to bracket out your time on your charts, you'll be able to do that and see very clearly when highs and lows form. Now, with that understanding, okay, we can start now increasing the level of accuracy by having this insight of risk on, risk off. And what I'm going to do is now I'm going to add a period separator. And what I'm going to do is I'm going to add it to 5 GMT. And what that's going to be is midnight to my time, okay? And it's very, very light, I know, but it's right here, this vertical line, okay? And what I'll do is now I'm going to zoom in a little bit more. Right in here is midnight in New York. Now that's when I call the new day. Now obviously there's trading prior to that, okay, but I call that the Asian session or Asian range. Asia goes a little bit farther, but obviously I look at this vertical line or delineation of midnight New York as my beginning marker. This denotes the new day to me. What you'll want to see is if you're expecting, again, the dollar was at that time trading at a support level, okay, or what we would expect to see support. So that would be a risk off scenario, dollar rallying, foreign currencies going lower. What you'll expect to see happen is specific times of the day will translate into setups. Okay, you have a key high here. Okay, little short-term swing high in here. Watch what happens when you take your fib and the low prior to this vertical line here. What you're going to be expecting is you want to see a rally. Okay, you want to see a rally after midnight New York, because that rally is the sucker play that neophyte traders get lulled into believing that this is a buying opportunity. Okay, and let's zoom in just a little bit more just for clarity. Yeah, right there. So we have this high here and the low prior to the move going up. Now the move up at the New York midnight time, which is 5 GMT. Again, the easiest way for you guys to do it is set a clock, some shape or form in where you're at as a trader. Okay, put it next to your computer, put it on your computer, put it on your phone, put it somewhere. Whenever you're watching my videos, or when you start watching my live sessions, when we start doing this stuff over the shoulder, it'll obviously make a whole lot more sense then because you'll see it. But if you can't watch the live sessions as they're occurring, when you watch the recordings, it's not going to make any sense to you unless you have the exact times lined up with your charts. And if you only do 1 or 2 trading sessions in London per week, if you trade like this, that's all you need. You don't need to do every single day. But we're understanding that we are in an environment where cable or British pound USD should decline if the dollar is going to find some support. Okay. Now, what will happen is you'll see the price rally up after midnight. Now, when will the signal occur as it starts to rally? We understand that looking at price moving the opposite direction is optimal for entry. You can see that price just fell short of the 79% retracement level right in here. Didn't quite get there. The high on that candle is just a pip below where the actual 79% retracement level is. But look at the level of rejection. Once it gets to that level, boom, takes off and trades the other direction. Okay, so by having the simple approach to using the fib and using the ICT optimal trade entry or OTE, which is simply just looking for a minimum of 62% retracement as much as 79% retracement, and looking ideally for the sweet spot, which is basically the midpoint between 62 and 79. Now, I do not use the classical 78.6 and 61.28, whatever. I don't even know what they are. Okay, I don't really care that much. Okay, to know what they are. I just make it very simple for me. Okay, and some can argue that this isn't as accurate as it should be, but whatever floats your boat. Bottom line is it does enough for me, and it makes it easier to teach it this way and to my children, because really you are just beneficiaries of the resources that I'm actually sharing with my children. So when I'm talking, I'm actually talking to my children, that I have them in mind. So if sometimes I come across oversimplifying things, that's the reason why, because I'm talking to my children. So understand that I want this as easily digestible as possible for them. And if something happens to me, they'll have these resources to turn back to, and they'll have everything that I have, hopefully, in my mind translated through these resources and reference points. But the rallying up, okay, what makes it optimal is there's a large degree for price to not go very far once this framework is established. And what do I mean by that? Well, if the dollar is poised to trade higher, or we believe that the dollar will rally, okay, we want to look for ideally a sucker play or rally into. You want to sell into this rally. I know it seems scary, okay, and it will seem scary for a great number of weeks and months until you understand by desensitizing yourself over and over and over again, doing the same thing over and over again by drills and studying and expecting price to do it, anticipating price to do it, not trading, not demo trading, okay, but just studying price and saying, okay, it should react at this level. It should do this today into the London session, and then it should do this going into New York. Having these ideas ahead of time will build your confidence and your anticipatory skills as a trader, which is essential. You cannot make money reacting to the price, okay? You can't do that. You have to be anticipatory in nature as a trader. That way you can identify when there's a most likely phenomenon to unfold. And what is that phenomenon? How does it repeat itself? What does it look like before you can identify a repeating pattern? And that's what we're showing here. The simple notion of looking for a rally up after midnight. Now, why is this important? Okay, I taught a principle, which is I dubbed as the power of three. And really what it is a very simple idea. On days that are up, well, since we're talking about a down move, let's just work with that. If we look at a candle, and we're going to say this is a whole full daily range, okay? And again, this is a graphic depiction of a daily range. I'm not going to go to a daily chart and show it to you, but we'll be able to see it in the price action over here. Typically, what will happen is price will open up, trade just very, very little bit above the opening price. Now, what's the opening price? That's going to be the question. Okay, well, there's two opening prices that I reference. It's the opening price at 0 GMT and the opening price at 5 GMT. Both of those opening prices are sensitive to me as a trader. I want to see what we do at those levels. Okay, how we trade at, above, and below is important to me. If the context to my trading idea is the dollar is rallying, okay, or poised to rally, I want to see obviously the opening price in New York midnight time. Okay, I don't like to trade during Asia. You can, and it's not my point to teach that in here. It is my point to teach you that from 5 GMT, which is New York midnight time, from that point on, if we're poised to trade higher in the dollar, you're going to expect or anticipate higher price rallies after midnight in the foreign currencies, like for instance the cable here. The British pound should rally. When we see that rally, we do not chase that thinking it's going to go higher. We look for this. We are happy to see this. Okay, emotions can be permitted here because we are expecting this to unfold, and it does unfold. Okay, so that's where emotions are acceptable. We expect this this phenomenon to take place. We do not get excited about taking trades. We do not get excited about over leveraging. We do not anticipate making money and getting excited about that. We are looking for the phenomenon to repeat and then growing in confidence by seeing this occur over and over and over again. But back to our analysis over here. Understanding that initially price will open up, and we'll just say that the low of this portion of this box is going to be representing the opening price at the vertical line delineating midnight in New York. Okay, price will open, and then whatever it does above the opening, that's what's important to us. That's where the signal takes place. The sell signal will occur above the opening price. So anything at the opening price or above, that is our selling kill ground. Okay, the killing ground is above the opening price. We want to see that initial little move up above the opening price. Now, why is that important? Well, because my mentor, Larry Williams, said he wishes he understood how people could sell up in that upper portion of the daily range and then capture the big move going lower. Well, if he says he couldn't do it, I took that as more or less a challenge that, hey, if he can't do it, I'm going to see if I can. And I've spent the last 20 years trying to master, if you will, that very thing. And I've done very well in terms of getting very close to deciphering it. I haven't quite figured it all out yet, but what I've figured out enough, okay, is to make a really wicked living. It's crazy how much money's available. But in here, in the red portion of the box, okay, this is going to equate where the sell signal occurs, and we'll talk more about that in a minute. But your idea is you want to be selling on a down day or anticipatory selling scenario. Okay, you want to be getting in here trying to find a sell signal. Okay, and once you get in it, you want to anticipate the daily range expanding. Now it'll go up and down intraday, but as we make a lower low, that's the daily low intraday. And as it retraces, it'll many times blow through that new low. And as it retraces again, it'll blow down lower and lower. And eventually what will happen is around London close, okay, which is, again, we're going to reference New York time, from 10 o'clock in the morning to noon, okay, New York time, that's typically what I classify as like the London close time frame. So if we're in a down day, the low of the day will form between 10 a.m. and 11 a.m. 70% of the time. But it can go as late as noon sometimes. And unless there's a FOMC announcement or something like that, those types of events will cause it to go as late as 1800 GMT or 2 o'clock in the afternoon New York time. Okay, so there's your parameters in terms of time. But what you're looking for is you want to see the largest degree of time to permit the daily range to unfold. Now let's take a look at what that looks like in on this daily range here. Okay, obviously we have the optimal trade entry in here. The sell signal is right up here, and I'm going to bracket out with this little box here when price entered the sell zone, okay, for the optimal trade entry. Okay, and what I'm doing is I'm mapping out this box, this crude depiction of our daily range here in a second, soon I get the colors matching like it should. Okay, right up in here, this little area here is this point right here on our idea graphically what a down day looks like on a daily range. Okay, this is that right there. Okay, this maroon portion, or the range expansion or profit release portion of the down day, where the largest lion's share of the move occurs, okay, that will occur from the entry point that happens in London Open to as late as 1800 GMT for FOMC days, okay, or 2 o'clock in the afternoon New York time, okay. Ideally, the opposite end of the range, or in this case, the low of the day, will form between 10 o'clock and 11 o'clock in the morning New York time, which translates to 1500 GMT to 1600 GMT, okay. But again, you got to allow a little bit of fudge factor for it may monkey around till noon. But generally, I think you'll see that if you put the reference points of 1500 to 1600 GMT, or basically 10 o'clock in the morning to 11 o'clock in the morning New York time, that will be the opposite end of the range of the daily range. In other words, if the high is made in London Open, the low of the day will form between 10 o'clock and 11 o'clock in the morning, okay, New York time. And that's pretty much how the daily ranges unfold. So the market makers are actually doing their work and bracketing and capping the market high and low at those specific times of the day. And generally, volume really increases and enters the highest point here and falls off in the latter portion of London close. And it's usually what typically drives the internals behind why this does occur. So market trades down, makes a low right here. This is the low of the day, and this is an ugly intraday price action, but still nonetheless it'll help us as it relates to understanding what price should do and shouldn't do. The big portion of this graphic depiction of a daily range, okay, we have the opening. It dilly dallies around the opening price for a little while, then rallies up. That's what we're looking for. That's the Judas swing, okay. That's the open rally decline scenario that we like to look for, okay. In other words, we're making the high of the day first. Now again, I'm not going to argue that we didn't have a higher high back here, but I'm referencing New York midnight time as the beginning of my new trading day. Please don't get in arguments with me. That's not the trading day's beginning. I don't care what your opinion is, okay. And I don't mean to be rude, okay, but you're watching my videos. I'm not subscribing to your views. I make a living doing this, and a lot of it, so it's important that you understand how I'm interpreting price, okay. That's the whole reason why we're doing this, okay. It's not for me to learn from anyone else. I've arrived at what I understand in markets, so I'm comfortable with that. I'm not forcing my views. I'm not forcing you to do this only. It's just up to your interpretation of whether or not it's valid or not, okay. And I challenge you to put it to its test. You'll see, while it's not 100% and nothing ever is, this will give you exactly what you're looking for. And that's the reason why I open up these videos with that statement. I know exactly what you're looking for. It's what every trader is looking for, but no one is willing to, basically withdraw from their treasured views and ideas and their techniques and their applications of indicators. If you just put that aside for a moment, okay, and I know it's difficult because you're passionate about what you already believe you understood about the market, okay. When you remove all that stuff, okay, and I'm being nice by saying stuff, get to the core root of why price moves like it does and when it does, okay, and who's doing the movement, okay, then it becomes a suddenly much easier environment to work within, okay. So let's get back to this example here. The opening up in here to the price above the movement above the opening price at midnight, okay, that's the classical London Open ICT sell scenario, okay. We are expecting a bounce, based on this level up here. We broke through, resistance broken, later turn support. This was noted when the price ran through here live, not this day, not this day, not this day, not now. Okay, this was all on the chart in a live session with witnesses that I expected this environment to unfold. Okay, so again, understanding risk on, risk off, this would be a risk off scenario if we anticipate a bounce at that level. Going back to our cable, we're looking for sell scenarios. Okay, so now what does that look like? Well, it's going to be a down day in a move that is going lower. If you look at daily charts, okay, daily charts will show this. Let me pull up a Virgin chart here on the cable, and we'll just do a daily with the open, high, low, close. And I know this is probably alien to most of you. You're all been indoctrinated to the world of candlesticks, but you know, it is what it is, I guess. Let's go to a daily chart. Okay, and this is Wednesday, Tuesday, Monday, Sunday, Friday. This is that environment that I was just describing. Let me go out here and zoom out. There we are. This opening, see that little bit of a movement above? Okay, the reason why it's showing just very little movement above the opening is because this opening price is referencing the opening price at 0 GMT. Okay, but the overall pattern, okay, what I was describing in my graphic depiction is this really. Okay, you see the opening trades up. This up move occurs many times from the reference point of midnight in New York. If you look at the rally from that point on, that's where this occurs. Can it happen in Asia like it does here? Sure. Okay. But it doesn't change the fact that you still can find the moves, okay, in the midnight time frame looking for that Judas swing. Now I'm going to talk more about that Judas swing in a moment, but this is the phenomenon that we are expected to see. This open. Now this is not the day, obviously, but I'm showing you what it looks like, just like it is here. We see the opening, the move up. Really look at what's going on here. Okay, this is daily chart. These bars represent the full daily ranges for each trading day for the cable. Look at what's been going on for the entire time this thing's been going lower. How many days does it do this phenomenon? Watch. I gave you guys an example of study, and I'm actually incorporating it in here in this description of the things that I've done over the last 4 years. So I'm going to answer the drills that I gave you. Now, I told everyone to study price in the whole month of June while I was on holiday, and I wanted you to do these types of things. Now, I'm going to reference June in a moment, but for right now, let's take a look at what's going on for the cable. In this prolonged down move, let's count the days that we had an open, rally, and then a down day, close. Okay, in other words, it will have an open, a high, and then a lower close. Okay, watch. We have one here, even though we're a little bit off the opening, it's still giving an opportunity to make money on a down move intraday. Here's the second one, down close. Third, Sunday, who cares? Didn't do anything. Monday, open, rally, down close. Open, rally, went close lower, but we had intraday range below the opening. Open, rally, down close. Open, rally, down close. Open, rally, down close. Sunday, unchanged. Open, rally, down close. Open, rally, down close. Open, rally, down close. Open, rally, down close. You see that? Now listen to me, guys, okay? I don't care who you subscribe to. I don't care which author you read the most and have the most adoration for, okay? I'm going to tell you something right now. If this information is generic and as simple as I just explained, does not knock your socks off, you haven't been paying attention. Everyone wants to make money. Everyone wants to find trades. Everyone wants to know what the directional premise is. This just answered all those things for you. How many trading opportunities was this just in the last month? Think about it. In the last month, how many trading opportunities? Tons. Absolute tons. If you were trading even with the wrong bias back here, say you were trying to sell every single day in here, okay? And say you were, you were trying to capture down moves, okay? The days that it had an opening and rally, okay, maybe you lost on this day. Who cares? What about this one here? Maybe you didn't do anything there. You made something here. How about this day? You probably would have lost money. How about this one? You probably would have lost money. What about this one? You made money. What about this one? You made money. So you had 2 losses, 2 wins. It shouldn't bother you that you're going to have a losing day, that you're going to be wrong. Because I'm going to tell you right now, write this down in your notes. Inner Circle Trader, Michael Joe Huddleston, promises you, guarantees you that you're losing money using this stuff that I'm teaching. You're losing money. I'm telling you up front, you're going to lose money. Now, if you listen to me, the losses that you incur are going to be very manageable and they're not going to take you out of the game. And also on that same coin, flip it over, when you listen and the trades pan out, the level of money that you make, okay, or is available, I should say, let's rephrase that. If you follow all the rules, the ideas will more than adequately erase the losing trades and show you a net gain. How much of a net gain is going to be dependent upon the level of trader, the experience, and the risk that you're willing to assume. Keeping risk limited, obviously, as a new trader, if you're just now getting into this stuff with me as in terms of my methods, okay, or even trading at all, you should be trading about 1/4% risk, even in a demo account. I know that's not sexy, but it's not about making money right now. It's about understanding what you're doing. Think about it. Say you want to be an auto mechanic. Okay, you sign up for your schooling and you want to get in there and they give you your textbook. Are they going to let you go out there and take apart a Maserati just to see if you could do it? They're not going to let you do that. Okay, you got to understand theory, and that's where you're at as a new trader. Some of you guys have been following me since 2010, and you still should be in theory because a lot of you guys rushed into trading live. Okay, and then you're sending me emails saying, I'm really not understanding what's going on. But then you'll send me 1 or 2 emails over a course of 3 months saying, I think I got it again. No, what you did was you just happened to have the right move that day, but you haven't been applying the tools because there's a plethora of multiple setups that happen throughout the week. And if you just focus on one trading pair, you'll be able to learn these concepts. And once you understand it, you can apply it to every one of the pairs if you want to be that crazy about it. But understanding that if we're in an environment that is most likely going to be going higher or lower over a long period of time. Now, why was I discussing this down move here and why is that important? Well, think about it. If this was going down, what should the dollar been doing at the same time? Rallying. You see that? So that's how you get institutional sponsorship behind the trades that you're taking. If you see a risk off scenario, which again, that is dollar rallying, dollar-based rally is going to see a decline in the British pound. Okay, the British pound is going to be falling against the dollar. What you're looking for is the opening, rally up, sell into that, and expect the down move to occur and have a lower close. You want to see range expansion. Okay, range expansion is this thing here. When you have the daily range, we have the opening price here, trades up as we see here. So really, I guess we should be really just saying this. The opening price is right there. Okay, so this little box in here, that's represented right here. If this is the daily range, like we see on this example, like say this right here, this is the daily range itself. Okay, graphically depicted over here, the opening, the initial move up from the opening price, which is here. Look how much opportunity you had to find sell scenarios just above the opening price, just selling it. Okay, if you're worried about being stopped out, if you're afraid that you're going to be stopped out and you're going to lose money, okay, you need to stop that. Throw that out right now. I'm going to take away every excuse in the book for you right now. Okay, are you ready? Nod your head. I'm ready, Michael. I'm ready. Okay. What you're going to do is you're going to look at an example of time and price as it relates to stop loss placement. Okay, now assume we have this idea that we think price is going to trade up to this point here because we already identified our range. Okay, we understand the time of day. We understand that we're above the opening price. Okay, we want to sell in here. So where should our stop be? Well, it should be above this high. That's what our textbooks teach us, right? Okay, great. That's fine. But now let's talk about why I always talk about using a standard 30 pip stop loss. Now I know you're thinking, wait a minute, I don't want to use a 30 pip stop loss. That doesn't sound like it's going to work out well. You know, that's going to be a big loss. Well, it would be if you have a lot of money in terms of your risk exposure over 30 pips. But what I want you to look over here, when I put this little thing, this little cursor here, notice those little numbers. Right now it says 32. Now it says 24, 41. Okay, what I'm doing is I'm putting a range of 30. See that? That's 30 pips right there. Now that rectangle is graphically depicting where 30 pips range is in deference to wherever I want to place it on the chart. If this is where we're entering in London Open at 8:15 GMT or 8 GMT, which is basically 2 a.m. I'm sorry, 3 a.m. 3 a.m. New York time. If you take that entry point, and we're going to use the 62% line right there. So what I'm doing is I'm taking that range of that 30 pips on this rectangle. I'm putting it right on that level right there at 62. And I'm adding 30 pips to it. Right up here, that's where your stop loss is. As you're learning, this is what you're going to do. You're going to place your stop loss order right there at 169.12. Your entry price is at 168.85. No, it's not. Let me get that. Let me make sure I'm saying this right. Okay, right in here. You have 168.82 and 30 pips away is 169.12. Okay, so you have this much in terms of space between where you're entering and where your stop loss is going to be. Now, what does that mean? Well, whatever you sell here, okay, if price was to take you out and by trading up to that level here, okay, and really that only has to happen by trading at 169.09 would take you essentially most like in most platforms it would take you out if it traded to that point because you got that factor to spread. So you're probably really in even though you're looking at 30 pips, the market many times will take you out at 27. So why do I use 30 pips? 30 pips, I want you to do a study, okay? I want you to look at days that create the down moves, okay, in London and makes the high. Take 30 pips and add it to that high of the highest high during 2 o'clock in the morning and 4 o'clock in the morning New York time, okay? Whatever the highest high was, put it on the highest high there and add 30 pips to that, okay? And I want you to count how many days that 30 pips gets taken out or would be stopped out, okay? And why am I saying 30 pips? Well, if we were to be very generous and say that the average daily range for our currency pair is 100 pips, okay? If it's 100 pips, how much of 100 pips is 30? Roughly a third, okay? The idea behind this, okay, and it's really nothing I can attribute to any other author, because if it was, I would just simply take you to their work and say, okay, read this and you'll understand it. If this is 30 pips, and it's not, okay, but let's assume for a moment that this is the daily range of 100 pips in 3 stages. Let me just do this. So if this whole larger rectangle, if you will, represents a daily range of 100 pips, okay? If we're trying to sell it, and we sell it anywhere up in the upper portion of the range, okay, we're trying to capture this type of event, a move up from the open and down and capture some profits. If we're looking to sell up in the upper third of the range, okay, if we're already in the ideal location of a down day, what's the likelihood of it moving 30 pips from that point and then making a lower low and a lower close? Unless it's economically driven by a report or a market moving event, okay, like FOMC or non-farm payroll, those are the 2 reasons why I do not trade those days, because that's when it can very easily blow through 30 pips and clean out both directions of the marketplace and go back to the center of the range for the daily range and go nowhere. And basically no one makes money that day by doing that, unless you're an ultra short-term scalper and you fade that move. And I don't like to do it because it's a carnival ride. So FOMC is a joke. Don't play it. Don't trade it. Don't be in front of it. And non-farm payroll, there's absolutely no reason why you should be in there doing that, unless you want to play in a demo account and just play in a sandbox. But what's the purpose of doing that? You can do real trading. 20 19 more days, if you will, the rest of the month, and actually have days that are absolutely in favor of volatility, that is indicative of price action that we can trade with. So again, that's the reason why we like to use a 30 pip stop. Now, over time, you will learn to be able to trim that 30 pip stop loss down. I'm not going to tell you that you should get down to 10 pips or that you should get down to 15 pips. Okay, you can make a career leaving it at 30, but what do you do when you have your entry point and you know where your stop loss is going to be 30 pips away? This should be no more than 1/4%. Think about what I just told you. 1/4%. If you're just now starting, that's the level of risk. Now, why am I telling you that even in a demo account? Because if you lose money or make money in a demo account, it by default, it strategically plans, okay, your thinking to think about money. And I'm teaching you to think about the risk. Everything that I'm sharing with you will by default put money in your account. It will also require you to stick to a low risk, high probability scenario. This is one of those events. They happen a couple times a week, every single week. The problem is, are you going to be there when price does what it does? Think about it. There are several opportunities in the week that really set up really favorable trading opportunities. They're not scalps. They're intraday day trades. People that have jobs can still do these types of trades, but it will require you to wake up at midnight New York time. Take a glance at where we're at. Look at whatever previous range is, okay? And then you're going to basically use that as a basis to determine where your trade setup's going to be. Ideally, I think London, if you're going to trade it, you need to be awake in front of the charts, okay? But if you are really gung-ho about what you're seeing on the charts at midnight, okay, you can use the previous range here, or if you're watching price, what I like to do is I like to see an intraday high getting taken out, where like we have here, this is a high in here. If you draw out a little line, let's do that. Actually, I drew the wrong one, but that's still, it'll work. This is the high, okay, and anything above it would be a turtle soup or stop raid, okay? And by having that idea, that would be another pattern you can use if you're not an optimal trade entry fan, okay? The other pattern I like to use a lot is the turtle soup, which is a false breakout, okay? And many times, that's really classic London Open setups. It's just one of these previous intraday highs, and there it is. That's what you sell into. But without having the context of understanding that you're in an environment that you're expecting down moves on a macro level, okay, you're not going to understand how to zero in on these very, very, very small little time frames and segments of the daily range to ferret out these opportunities. We already told you what time of day these things occur. And I'm going to give you, let's see, what can I show you here? What was I going to do here? Let's do this. Okay, yeah. Let's zoom in. And let's go to that same day. And where are we at? Lost my spot here, guys. Yeah, August 1st. Okay, August 1st. Okay, so we talked about the London Open Kill Zone, and this indicator, which I'll be sharing with you guys, I'll send you a link through Twitter where you can actually go and download these from my website at theinnercircletrader.com. The blue line in here, this is viewed as bracketing out, if you will. And I like this form. I used to be able, I used to draw it on my charts, and spend all the time doing that in my videos. But I liked the idea of having it very clean at the bottom because I understand the window of opportunity, and I really want you guys to think that way and keep your charts clean. At the beginning of that line, which is right here, okay, and the end of the line, and again, we're talking about this little blue little section of time. This whole pocket of time of day is the ICT London Open kill zone. Okay, it can extend to 10 GMT, which is basically 5 a.m. New York time, and it can start as early as 1 a.m. New York time or 6 GMT. Okay, but by far and large, between 7 GMT and 9 GMT, or 2 o'clock and 4 o'clock in the morning, that's usually when the high or low of the day forms. Now, what does that mean? Well, if we have already arrived at the idea that the dollar during this time has been in an already established up move, and we come down to a level we're anticipating support, we expect a bounce in the dollar. Even if it's short-lived, it gives us a prognostication of future price action in the cable. And you see that happening here with lower prices, okay, extending lower. Going back to our intraday, this is that move up, okay, that occurred. But look what's happening. This blue area here, it just helps us identify when these moves are going to occur. So we understand time of day. We understand the range expansion theory, that the daily range will move down and the daily bar will become larger throughout the day. But the beginning of the move on a down day occurs at London Open at a predetermined measurable move with retracements at the beginning of a time of day like session. This is the ICT kill zone. Unique to me, between 2 o'clock and 4 o'clock in the morning, that's going to be your time window where the setups occur. So what am I teaching you here? I'm telling you how to find the moves. I'm telling you how to pick the direction of the day. I'm telling you how to anticipate the setups to occur. Both my patterns that I trade are always overlapping. Okay, the optimal trade entry, which is retracement driven, right here. Turtle soup, a short-term high, rallied through, it's a false breakout, boom, that's what you want to sell into. Okay, when? During the London Open session. How long do you hold it? Until London close. Later in the day, you want to see range expansion going lower. It really expands and drops off precipitously here. I've told you how to place your stop loss. Use the 30 pip stop loss. Why? Because the chances of it opening at New York's midnight time frame, okay, or even the beginning of the new day over here, and moving 30 pips up and then moving down, doesn't happen. Can it happen? Sure it can. But it's so unlikely, okay? There's no reason for you to be afraid to trade. None. If you're afraid, it's because you're trading too much money, and if you really ask yourself honestly, if you lost on that trade, would it hurt you? Yes, it would hurt you because you got too much leverage on it. If you start off with very, very, very ultra low risk, 0.25 of 1%, okay? In other words, 1/4 of 1%, you're not worrying about money when it's like that, okay? Because it's so minute, it isn't going to hurt you. It's not. You could take 100 losses in a row with that, and you're not out of the game, okay? You're nowhere near hurt, okay? You could still come back from that, absolutely, okay? So think about it. I'm telling you to trade in a demo account setting for 6 months. 6 months. Why? Because it's going to take you that long to really trust what it is that you should be doing. Now, if you're in a fast track view of things, you have to do it because you got to get out of your job, and you got to make life changes that have to happen shorter than that. Do not send me emails saying that your stuff doesn't work because I couldn't quit my job in 6 weeks. Okay, I'm telling you it ain't gonna work like that. Okay, I'm telling you, if you do not invest 6 months of your time, your hard-earned free time, to doing this stuff, you don't watch my material. Find something else, because I'm telling you, my work requires just that, work. And I've condensed 2 decades worth of insights and experience down to what I think, and I mean this wholeheartedly, there isn't anything out there better than what I'm sharing. Not one thing, not one mentor, not a collaboration of mentors. And I mean that with every sincere fiber of my being. And it's not to be braggadocious or arrogant. You can call me that. But I'm telling you, I'm the best thing going today. And the materials I'm giving you cost you nothing but the time sitting in front of the computer. Now, granted, it may be a whole lot of time between the videos, but I've already promised you that in the beginning, didn't I? It's going to take a lot of patience, and it's going to be expensive in reference to time, because I have to force you to do this over a long period of time. Otherwise, you're not going to glean what it is that you need to glean, because you don't know what you need to know. You don't have any idea what it is that you need to know. But it's going to be me taking you to the chart, looking at specific things over and over and over again. Then you'll start saying, well, yeah, now I see it. Of course you do, because you've been doing it and you've been desensitized to the fear aspect of trading, losing money and being wrong, because that's really all it is. That's it. Think about it. What are you afraid of? Being wrong or losing money. Both go hand in hand, okay? But those are the two primary fears. That's it. We can accept missing moves. We're not really afraid of missing moves, okay? We're disappointed if we miss a move, okay? But we're fearful of losing money and being wrong. They're the two primary pillars of fear as it relates to speculation. There's other pillars, obviously ego, and that's the folks that spend a lot of times in forums and they share their insights with other people and think that they're smart and try to be better than the next guy, okay? Don't be in forums. If you're a developing trader, unless you're in there just reading from someone that has a lot more experience than you, okay, and they're giving worthwhile investment advice, okay, obviously, then yeah, read forums, okay, but you should not be in there trying to teach other people when you don't know what you're doing either. If you're developing, don't try to teach it to anybody, because you're really doing a lot more harm than you're helping. And I'm encouraged by seeing individuals try to do that. But if you're not making a living at this, don't teach it, okay? Because you're still developing, and there's going to be a whole lot of lessons. And my greatest learning happened in the last 8 years of my career. Now put that in perspective. You guys want to start trading and quit your job in 4 weeks, okay? And I've been doing this for 2 decades, and my best understanding and learning happened in the latter part of my career. Think about that. I wish I knew now when I first started. I wish I knew this stuff. I wish I knew this, because it would have been a whole lot more different in terms of my development and the pain I had to, and basically go through. And it was self-inflicted. And I'm hoping you guys learn from that. And I keep bringing it up because I want you to understand that I'm a real person that went through real problems with this stuff. Real medical problems. I mean, it hurt me physically to the point where I still can't eat comfortably. I have a difficulty swallowing foods. It will warp you if you let it. It'll make you think you're bigger than you really are. It'll make you think you're smarter than you really are. And it'll also make you feel much less of a person than you really are. There's a lot of influence that we allow these marketplaces to have over us as a human being, but it's all manageable. It's all controllable. You have control over it. There's nothing forcing you to put that trade on with 5% risk. There's nothing forcing you to sit there and say, I'll pass on that trade, except for common sense. You're in the driver's seat. I don't want credit for your winning trades, and I certainly don't want credit for your losing trades. This whole thing is about what you do at the end of this development. That's what I'm interested in. I want to see what you do with this information. Once you become successful with it, how are you going to help other people with it? Because that's what I'm doing. I'm helping you for free. I'm not asking for anything except for share your story with me. I want to know what you're doing with it. I'm not going to have some upsell later on $2,500 workshops come out here, and I'm going to help help you even further by taking that money and putting some hokey software program together to help you find trade patterns. Okay, you don't need all that stuff. You don't need any of that. Okay, if you're looking for software programs to find trades for you, you're lazy. You're friggin' lazy, and lazy doesn't pay. Get that in your notes. Okay, doesn't pay. I tried that. Okay, and a lot of other people tried it too, and it never pans out. You understand how the markets operate, like we're sharing right here. You'll find trades immediately. You know when they're going to happen. I don't need a software program to show me when a pattern is on the chart. I know time-wise, daily, the day of the week is going to occur. I know what time it's going to occur. I know how the pattern's going to unfold, and I know where it's most likely going to go directionally. Tell me that software program is going to do that in advance. I could tell you the days of the weeks in months in advance when those patterns are going to happen because they're that generic. I'm sorry, but everything else is playing catch-up ball to what you're learning. This is how the market's operating. I'm not trying to sell you the idea. I'm telling you, challenge me on it. Go through the processes that I'm sharing with you right now, and you tell me that it doesn't work like this. You tell me, you show me that it doesn't work. I've already put it out there. I will give you $10,000 of US currency, cash, to a PayPal account, to whatever you want to do, okay, how to receive it. You show me how this does not consistently work, and you can't be consistently profitable, okay, by doing what I'm showing you. I guarantee you it's impossible for you to not be successful with this. Think about what I just said. That's a very, very heavy statement I just laid out there. But I mean everything I'm telling you. If you do everything I'm showing you to do, development exercises, doing the process of looking at everything, breaking the market down like we're showing right here, having a risk on risk off scenario, trading with institutional sponsors behind the ideas of your trade, do you have the framework that's cognizant, okay, or not cognizant, that is a representative of what the market should be doing, moving higher or lower? If a bear market's on their way, what does your daily charts look like? Down days, right? How do those down days start? Typically with an up move intraday. That's usually catching many traders by surprise. Wait a minute, I bought that. Here I am buying the high of the day. Guess what? I did that. And you're probably doing it now. There's an answer to it. And it's by taking yourself out of the textbooks, out of the guys that want to sell you things and teach you how to be the greatest trader in the world, okay? Let me tell you something. If they're selling you that stuff, they need the money. If they need the money, they ain't that good of a trader. And it's just that simple. I don't need your money. I don't need your thank yous. I don't need any of that stuff. I covet it because I enjoy reading the success stories. Market Wizards, Volume 1 and 2, favorite books because I was inspired by them. Not all of them, but several individuals in there I was inspired by. I liked their story. I want more of that. Swagger's not putting any more books out there that are engaging to me. So I want to create more. Okay, I want to create more stories. And I like sharing my story with you guys, and it may be a broken record to some of you. Okay, but I want to see more of that. And it's going to come through you doing these very things. Okay, so I know I'm on a soapbox and I went down another rabbit trail, but you know, that's all part of the price of being in these videos, guys. You knew that in advance. There's going to be rabbit trails and there's going to be things that you're going to have to listen to and rants and just suck it up. So now, using this example, we understand that we're in an area or an environment, if you will, that price should be seeing weaker prices on the cable while the dollar should be poised to trade higher. Now, obviously in hindsight, we can see that as a fact, okay, but also I'm taking you back to the previous week when I have witnesses, okay, we're in a live session where I was mapping out all these things and possible scenarios. Obviously, I shouldn't have to be teaching you support. You know, if price comes down to support, where should price do? You know, go in terms of direction. If it's going to be support, it's going to go up. Okay, so if that's going to happen in the dollar, we're going to see weaker prices in the foreign currency markets. And simply because I like to follow the cable and fiber, obviously you're going to see that translated in lower prices between the two asset classes. Now, we identify the selling scenario during London. We like to see that set up. And once we're assuming that we're in the position, how long do we hold it? Well, there's several different things we like to do. We like to look at range projections, which is using Fibonacci, and swing projections, and we like to use average daily range, which is another tool. It's an indicator I'll share with you. I can't pull up the average daily range here on this day, but if you look at things like average true range, it'll kind of give you like the a 5-day average range of the last 5 days, and whatever that range is, you just add it. I'm sorry, you subtract it from the low. I'm sorry, good grief, I'm really messing this up. The average daily range or average true range of 5 days, okay? And if you do that, just take that range and subtract it from the highest high of the day, and it'll give you approximately where the low should form. Now, I can tell you this, the tool that I use is not average true range. It is a indicator that I've adopted. Okay, I wish I could remember where I got it from because I'd love to be able to give credit to where I did, but I just don't know. And if you guys know where you've seen it before, because I grabbed that off of a forum somewhere, but the long and short of it is that tool to me is really good. It's useful, and it's one click away, just taking your MT4, clicking it, and it's the ICT average daily range indicator. And I didn't create the tool, I didn't program it, okay, but I did adopt it as my tool for using average daily range. I do look at average daily range on a 4-week basis. I look at a weekly average, not average, but a weekly average range. I use a monthly average range, and I use a 5-day average range. And there's an indicator that I've seen out there that shows all three of those that you can have up in the upper left-hand corner of your MT4 platform. Man, as soon as I find out where I can get it, I will obviously start incorporating it in my videos and obviously share it with you. But if you do know what I'm talking about and have it, or can take me to that source where I can get it, I would love that, and I'd be very appreciative of it. But as it relates to swings, if we're looking at being a seller, obviously here, how long do we hold the trade? Well, time-wise, we already mentioned that we're looking for 10 a.m. in New York. Now that is representative of the beginning of this red line. Okay, now this green line here is New York session. This is London close. London close, the beginning is 10 a.m. At least that's how I view it. So if we looked at that, I shouldn't have did that. Let's get this off. I have a mouse sitting right here next to me and I'm still using my touchpad. Good grief. Okay. This is the beginning of the London close session. So our idea is between this vertical line, time-wise. Now, this is a general theory. It's very generic, and I want you to test it, okay? And much like you see here, it doesn't give you the actual low of the day, okay? But I'm going to give you another scenario where you look for it using the New York session, okay? But you have two times of the day where you're looking for the opposite end extreme of the day. In other words, we're looking at a down day as it relates to this particular vertical, not vertical, but this down move here. This all from this line here to this line here in terms of time. This is all one day. We have this area here is where we like to see the low form on down days. This is where we anticipate it. But the low can form during the New York session. The New York session, okay, can either cap the daily range, in other words, make the opposite end that was formed. In this case, it's a down day because we have a high up in here in London. The low is formed here in New York and starts to rally up. This in here is a reversal market profile. Market comes down, makes a low of the day in New York session and trades. Now, later on, it does trade sideways going into the new day. But we do have the London close time frame. If you were to take profits from here, entering up here, and closing your trade out here, would you be upset about that? You didn't capture the very, very low, okay? You're out here. If you're waiting for perfect scenarios all the time and you're just going to hold to London close because ICT said London close time frame is 10 a.m. to 11 a.m. and I'm not going to get out before then, okay, you're going to miss some opportunities like this where you get out at a better price. So how do we answer that equation? Time and price. Time and price. So we have to incorporate a couple other things. Prior to this move down, this little spike up and drops, okay, this Judas swing up, we have this primary swing here. They may not be primary to many of you, but to me, this is how I look at market structure. We have a low, and the highest high in here, okay, is what we look for. Well, let's look at this right here. Okay, you see this? They're pretty much equal. So we're going to use a fib. We're going to take the low up to the high, and that's where we're dropping. Okay, you see that? When we have that, when we're looking for lower prices, we expect this swing to be measurable move. Once this low is taken out, which it is here, we look for 127, 162, and 200 extensions. 200 extension is basically a a doubling, if you will, of the range from the low to the high. Once the low is taken out, it'll move that much range equivalent from the low down, and that's what you get 200% here. Okay, the 162 extension is in here, and the 127 extension is here. At any one of these three price levels, okay, if price gets to it inside of New York or London, that's when you take profits. We were trading at the beginning of New York right here. So we were inside New York and we traded at the 200. That's when you take your profits. You can leave a little bit on expecting lower prices, okay, and maybe reach for the London close time frame then, but as it relates to perfection, you're not going to expect perfection. You want to take some profits out there. In fact, you want to take some out when we get below this low as well. You want to take a little bit off something. You want to take something off, okay? And if you can manage it where over time, if you start building your understanding of trading and you start working up to 2% risk per trade, if you do that, if you take off a half of 1%, okay, leaving 1.5% on the trade for the rest of the day, that will give you a huge head start in terms of satisfying the many times insatiable desire to be right. Okay, that hunger to be right is many times alleviated, okay, if you take a little bit off and you show a positive gain out of the trade. That way, even if it does come back and stops you out, you had something that you took out of the marketplace, okay? You can't be right all the time, and these tools will not 100% give you that level of accuracy, but it will give you insane accuracy that nothing else delivers. Going over to the fiber, okay, we're going to look at something as it relates to the same phenomenon, okay? Much in the same vein, we've seen bullish prices in the dollar, which would be translated in lower prices in the fiber. Okay, let's zoom in. And we're going to look at that same day. Okay, here's Wednesday today, Tuesday, Monday, Sunday, Friday. Take a look at what's going on here. See how price is rallying on that day? See that? This shouldn't be occurring. Think about it. If the dollar is poised to rally, what the heck is the fiber doing rallying? That is going to be a short-term sell scenario. Okay, now contrast that with what we see here in the cable. Let's go back over here and add candlesticks. Okay, here's Wednesday, Tuesday, Monday, Sunday, Friday. Friday's a down move. On the fiber, Friday's an up move. That don't make any sense, does it? Well, what you're looking at is this is actually a short-term trade, okay, versus a day trade. You have a move, it's moving counter to the directional premise that's established by the dollar, okay? In other words, fiber's rallying in a risk-off scenario. In other words, they're setting up a scenario that's going to be a little bit more of a move going lower, okay? And also, this is actually the weaker of the two pairs between the fiber and cable. If you look at what was going on, cable, let me zoom in a little bit here. Cable was making this higher high back here, while at the same time in June, July, the last day of June going into the first week or two of July, we made higher highs in cable. We did not see that in the fiber. Okay, we were seeing lower prices. In fact, it's been really soft compared to the cable. So the weaker sister between the two in relationship to the cable and Euro USD or fiber, fiber was obviously the weaker of the two. But we have this momentary break in that correlation. In other words, there's a rally underway. What's going on here is it's coming back to take out stops. Okay, and one of the things I talk about many times is the best moves occur right after a predetermined level of stops gets taken out. And that looks like this. Okay, you see these highs here almost equal. If you look at what we have, and I'll show you, this is it's really uncanny how this happens almost all the time. equal highs rather. Okay, so this price point, if you add 10 pips to that, that's about where all the stop losses are going to be for everyone that's short. Fiber comes up, goes just above that level, and I'm going to extend this line so you can see it. Sorry, my OCD is flaring. I got to make sure this level is lined up. Otherwise, it'll drive me crazy. Price rallies up through it, takes out this level of stops. Now, I'm going to zoom in on this particular day here on the 1st of August. And we're going to go down to a 15-minute time frame. Okay, and here's that rally up above a clean level. This is what we call clean, too clean. Stops are going to be resting just above that. Now watch, I've already told you what you're looking for. You're looking for a range of 10 pips. So you're going to put a rectangle right on that level of the highs. Okay, and we're going to look for a range of 10. See that little 9? See, there's 10. It says 5 here, 10. Drop it right there. That's as far as we'd like to see price rally up through and reject. If it does that, what we've just witnessed was a rate on stops. This bad boy's going lower. Now, notice also how I have the chart set up. Doesn't this look like a bull flag? Look at it. Doesn't this look like a perfect little bull flag? So all the classic chart patterns teach us that we should be buying this thing, okay? And we're going to expect to see a move. Okay, here's the flagpole. Here's the high. It's going to rally up from this level here. So we're going to expect to see price classically trade to about the 134.80 level. That's what the textbooks teach us. Well, that's not what happens. Okay, and by having that understood, okay, you got to understand that there are times when textbook stuff will work, but it's going to be when it's in line with the underlying tone of the marketplace when it's set up to move. Okay. What I mean by that is that unless it's risk off, risk on, based in dollar driven, and you have institutional sponsorship between your entries and your exits, it's not going to pan out. The banks don't care about your chart patterns. In fact, market makers love chart patterns because it gives them reasons to see more liquidity come into the marketplace. Okay, and what does that mean? Well, if you were a buyer down here, because you're looking at chart patterns, you're buying here. So what are you going to have to protect your position? A sell stop, right? Down here. So you're buying, there's going to be stops under here. If a trader can take you out, okay, in that position, they assume that difference in terms of price. You, as a developing smart trader, you want to say, I don't want to trade like this. In fact, I want to see where the stops on the other side of the marketplace are going to be. Okay, and what does that look like? Well, if the market expects, based on this bullish pattern, if it should be rallying, okay, they're going to be looking for continuation higher. Breakout artists are going to use these little areas like here, okay, and they're going to have stop orders to buy on a stop, okay, or they're going to be looking to wait for price to break out like it does here, and then they'll be a buyer. Well, you as a trader, you view that as the liquidity necessary for you to take the other side of the trade. So as price breaks above this high here and gives you a turtle soup pattern or false breakout, that's where you want to sell. You do not want to view that as buying strength. You should view that as a suspect rally. Sell it. Boom. And it falls out of bed. Okay. Now, the time of day for this, let's look at that. And this is on August 5th. So this is yesterday. Let's do the kill zones and zoom in. So August 5th, right in here. So we have the beginning of London right here, and it just your kill zone is just a little late here, which is the reason why we like to use the buffer. And I know that sounds like I'm always trying to form fit these results. But 6 GMT, okay, is 1 a.m. The moves can occur as early as 1 a.m. or 6 GMT. Having that in mind, again, I'm not, these are all in your notes, okay? That's the high right there at 6 GMT or 1 a.m. New York time. Boom, false breakout, trade lower. Which is the reason why I tell you guys always that I'm usually up between 12:15 and 1 a.m. my time, and I'm looking for London setups based on what I see, on the charts around that time. If you looked at what we discussed in relationship to midnight, here's 5 GMT. This little move here, that's all it's necessary. Okay, so I get questioned all the time. Okay, well, how much of a Judah swing do you need? Well, it depends on what you have on your chart. And I'm not trying to blow off your question. It really is just that simple. There's a lot of other framework you have to take in consideration, like we have over here. This looked too good like a bull flag, and a lot of participants are going to be looking to, try to be expecting this thing to go higher. Also, you got these guys that broke out on the downside. Price went lower. Okay, they're on the sell side. So now how are they going to protect their position? Okay, they're going to be putting a stop loss. Well, where's the stock going to be? Right above the previous little high, right in here. Well, when you look at price like this, you're thinking exactly how the market makers think. You're not looking at a retail perspective. You're looking at how the market is traded in the eyes of a dealer or a market maker. Your stop's going to be right above here if you're a seller. They come right back and take those guys out. Okay, so they neutralize any hopes of the bulls that use these bull flag patterns. They neutralize the participants that have been net short that would be profiting over here, but they don't want those individuals being profitable. They take the stops out over here because their stop loss is going to be above here. Boom, right above it, right above the Asian range high. And this whole little box here is Asian range. So if you understand that, you'll know that let me make sure I'm telling you that's true. I don't want you thinking it's Asian range and it may be central bank dealing range. Yeah, it's Asian range. Okay, this is 0 GMT. So this is Asian range. Price pokes above the Asian range high and an old intraday high, and then rejects quickly and trades lower. So that's that's the pattern that's there. You have your turtle soup, and you also have your OTE right here, right to the pip. Okay, so that's that's what it looks like going over both pairs and using the same context that we used for. Let's get this stuff off. We have price trading here. We went short here, so what do we use? We use the swings. Okay, we have a couple different reference points we can use. We can use this smaller one here up to the high. Okay, so you could be looking to take profit down here on the 200 extension, but there's nothing down here lining out that. So if we're looking for lower prices, you would be expecting this low to be taken out because stops will be residing under there as well. So dealers will be more interested in trying to get price to go underneath that low, and should it go to that point, we'll be looking to take profits at 127, 162, or 200 extension. You can see price comes down to 127. Look at the nice bounce that happens right there. And later on, it gives you another buy scenario here, which we're not going to teach that here, but it does violate this a little bit, but then rallies up. If you don't use this low here, you can use this low here. And write this down in your notes. There's no wrong way to take profits. And I'll say it again. There's no incorrect way of taking profits. If you make a profit, you are better than you were before you took the trade. Period. That's all you need to know. That's it. That's all there is. Okay. So now, if you'd used the primary move here, okay, you can use the 200 extension here, nails it to the pip. 162 extension and 127. They're all respectable levels. Okay, using the entry point. That's what I like to use that. If you're looking at just pure market structure swings and nothing else, you can use these classic reference points. This low to high, you get to 127 and 162. Okay, so I am adding both of them. I know some of you guys are looking at this. Oh, that's not how you. No, you're right. That's not how they do it. This is how I do it. This is how everyone else does it. They use a low to high and then they find the levels. That's fine. Okay, but there's going to be a lot of other targets that your classical application of fibs will never line up with, but you'll see me doing it in videos, and mine will be surgical and precision, and the other ones sometimes don't get met. And you have this low to high as well, and you get the 127. Okay, so if you look for a confluence of a lot of the levels lining up and old support and resistance levels, then you'll see a lot more reasons to cover at those levels, not just simply, hey, I made 20 pips, let me get out. If you do that and you're a London trader, you're going to leave a lot of money on the table, and there's really no reason for that. One of the greatest lessons I learned from Larry Williams was the best way to make money is hold to the close. And I did that as an S&P trader and a bond trader when I was day trading in the futures market. And it's absolutely true. I mean, you leave a lot of money on the table if you're just scalping and taking a couple pips and saying, okay, that's what I want to make my living on. So let's scroll forward a little bit here. This is where we're at intraday today. It's kind of ugly if you look at it, really what's going on, and yesterday as well. The idea of incorporating directional premise, when we have an area like this, okay, I'm going to pull up another US dollar, and we're going to do the averages on a daily chart. Okay, so we have a cross of the 18 and 40, and they start stacking right here. This is a really good time. So this actually occurs on July 21st. So we are in a really clear, institutionally sponsored bull move on the dollar. So that is going to be a precursor to looking for sell scenarios in fiber and cable. So remember this date, July 21st, 2014. Now we go over to the cable. Let's just go over here. Let me use this one. And we're going to apply the same thing. Whoop, that's not what I wanted to do. Okay, so we have, let's zoom in. We have a delay in the crossover here until, what day is this? The 21st. So we're looking at 10 days later before we see the same thing occurring in cable in terms of using the moving averages. Now that's for looking for swing trades. Okay, the 18 and 40 is used for swing trades or short-term trades. The way we look for day trades, for looking for short-term directional premise driven biased intraday trades, we use 9 and 18. Okay, 9 and 18 on a daily chart gives us the buy model and sell model. When it crosses over here and starts stacking, you're in a buy mode. You look for open down moves in London, buy the London open, wait for a higher close in London close time frame. That's how it works. Okay, if you're a New York trader, you look for that environment to occur, wake up at New York opening, get your coffee, get your donuts or whatever you're going to be stuffing in your face. Not to advocate eating donuts, but whatever you do, you get yourself prepared for trading. What you want to look for if you're a New York trader is if you're in this environment like this, London should have made the low of the day, and then what will happen is you'll see a minor little retracement in New York open, and then it'll continue on and trading into a higher close for London close. The reverse is said for the moves once you have the averages going lower here. Now, we have the averages crossing here, and this day is July 23rd. Now, we're very close now to seeing that 21st in July when we saw the bullish move underway in the dollar. See that? Okay, right in here. I'm just using this little retracement here as a reference point because I don't want to chase price. I want to see some sort of a retracement. That happening in here, okay, we see price on the 23rd in here. So we have a little bit of a retracement here and the crossing So on this day here begins the sell program for looking for down moves in the British pound USD or cable. Now, with that in mind, okay, we're looking at candlesticks. Candlesticks are great, easy on the eye, but what I really want you to pay attention to is using the bar chart. So on this time frame, now I want you to count the level of, oh, not level, but number of days where we have an open, a rally, and then a decline with a lower close. Okay, we have it here. This is a Sunday. Unchanged, could have been a losing day. We'll call it a losing day. Open, rally, down close. Open, rally, down close. Open, rally, down close. Open, rally, down close. Do you see what you've just done? You've put yourself in a driver's seat of a move that is completely out of your hands. No control whatsoever. You can't control price. But guess what you're doing? You're riding right behind this massive entity that we like to deem smart money. No one else out there really gets to the core of how to ride their coattails. You hear them, they say, well, we're trying to ride the coattails of the smart money. Well, ICT tells you exactly how to do that. It doesn't provide you an every single day trade opportunity if you're focusing on one pair. If you have a collaboration of pairs, then yeah, you'll probably get a trade every single day. Will you make 20 pips every single day? Probably not. Can you make 20 pips average every day if you do trading like this and you break it down? Yeah, sure, because you'll be making 90 pips one day, 40 pips another, 150 pips another day, and you average it out over 20 trading days, you probably are making 20 pips every single day. And I do that with my tongue in cheek, but that's what I'm trying to say. Don't think like that. Don't have daily goals, okay? Have weekly goals. My weekly goal is anywhere between 30 and 50 pips. It used to be 75 pips a day. I'm sorry, a week when we had bigger, larger ranges. But guess what? I adapted to the market and I've reduced it and I've gotten comfortable now with 30 and 50 pips. I can make more money than most average Americans in the upper echelon, okay, of middle class. I can do what they earn in a year inside of a month and not even do more than 50 pips a week, not a day, a week. So I'm comfortable having a whole lot of free time doing one trade a week. I don't need the money anymore. When you're developing and you're trying to get to the point where you're living on your trading, or when you don't really need to trade anymore, which is really where I'm at now. Trading is fun for me, but I like to obviously make money too because it's an interesting way of living, and you all are pursuing that lifestyle. But understand that you are not going to have to do that type of trading to do well. And it's very important you understand that, because if you understand that, it removes a whole lot of unnecessary stress and pressure. And I got to get it done right now because I'm 49 years old and I got to get my stuff paid off. And if you think like that, it's just going to be a problem. So don't. Okay. So now we like to see that phenomenon take place. So we know on July 21st, we had a sell program authorized by a rally up in the dollar. So in other words, the averages on the dollar on the daily chart were opening and pointing up, which was seen reverse here 2 days later on the cable. So from here over to present, this is what we have mapped out. So when we go down to a lower time frame, we're looking specifically for only looking to sell, not looking to buy. Okay, can you make money buying? Sure you can. I don't like that idea, and I think people that trade against institutional sponsorship are absolutely nuts. Okay, I'm sorry, that's just the way I feel. And the majority of the money is being made when you're having institutional flows behind you, not trading against it. Okay, I'm not going to arm wrestle UBS. I'm just not going to do it. So looking at where we're at here is the down move sell program in the charts. We go down one more level to 4 hour. Okay, and we move over to present. Okay, and when we have the averages broken down on that as well, because this is our intraday time frame, 4 hour. Okay, 4 hour is our intraday time frame. So when the averages are going lower, we have a green light go. Look for openings and Judas swings higher in London. Sell into that. Also, if London makes that high, we're going to talk about New York in a second, but we're going to look for the New York session Judas swing and how we incorporate that. But right in here, okay, we have a very nice indication of we're in sync with the marketplace. And who's the marketplace? The smart money. So now what we'll do is we'll add our vertical lines delineating the period separation, and we're going to go down to a 15-minute time frame. And we're going to zoom out a little bit more. Okay, from this point here to present, okay, I want you to look at the chart, and I want you to do this on your own chart because I'm not going to do every single one. But once you get down to the, sub 4 hour, you don't need the moving averages anymore. So you take the moving averages off your charts because you don't want to be paying any attention to it under 4 hours. They don't mean anything to you. If you're a scalper, you can use the 1 hour time frame and trade when it's in sync with that as well. But I do not want scalping, and I should have probably never told you that. But if you are looking for scalping, then that's how you use it with the 1 hour. But yeah, anything less than 4 hour, I'm not interested in with moving averages. Okay, because I've already arrived at a higher time frame institutional sponsorship based on daily and 4 hour. Now, looking at what we have here, okay, what you're looking at is every single vertical line represents a new trading day at 0 GMT. Shortly after, okay, when we add the period separator, and again, I'll share this with you guys, I'm going to put 5 GMT, which is midnight my time, okay, which is going to be represented by this white line, which now I'm going to change because I don't like that. It doesn't pop off at the chart so you guys can see it clearly. Let's go to colors, and that's not working right either. Let's see, what do I want? Let's see if I can get it to jump with the red. Well, no, it's not doing it. Well, I'm not sure how to do it, and I'll probably figure it out after I do the video and look foolish, but oh well, it is what it is. You'll just have to make deal with it. The white line in here is midnight time frame, okay, in New York. So what you're looking for is a rally after the white line, okay, or in other words, a rally to the right of that white line. Each day, the rally that occurs after that white line and up to the ending of New York ICT kill zone. I'm sorry, London open kill zone for ICT time frame between 2 o'clock in the morning New York time and 4 o'clock in the morning New York time, okay, or 7 GMT, 9 GMT, okay. And again, understand that it can go as late as 10 GMT or as early as 6 GMT, or 1 o'clock in the morning to as late as 5 a.m. New York time. So if go through this video a couple different times because I know I'm probably confusing you going back and forth between the two, but understand it's simply a window of opportunity when the higher low is formed for the day. We understand that inside this orange box, the point of the box is it's keeping your perspective and only looking to be a seller. You see the power in that? You do not want to be buying. There's no reason to be a buyer. Why would you want to do that? You're buying, okay, in an environment where the large institutional sponsorship, okay, is saying, I am not wanting to be long, I want to sell. So who has more money? Credit Suisse or Michael Huddleston? Clearly, I am not trying to go against these guys, okay? And when you're on the same side as them, trading works out. It's just, I don't know how to explain it other than that, it works out. So looking at every single day, okay, what you're going to look for is there's going to be a retracement or a swing higher. It could be an initial swing up for makes the high of the day, or it could be inside of the range that was already established from the opening at 0 GMT, which is the 0 GMT openings are the darker vertical dash lines. The white lines are New York midnight time frame. Okay, so now let's zoom in and let's go to the beginning, and let's add the candlesticks because it's a little bit easier to see. So here's your vertical line here, New York midnight. Okay, we don't care about the move lower. We don't chase that. We do not care about that. We want to see the rallies up. Okay, when it's rallying up, we already have to have in mind where the old highs are. Stops above it. Turtle soup, sell. Okay, new day here. Now I'm not going to go through all the details about how far it went, what time it stopped, and all that business. You can do that on your own, and I'm encouraging you to do that. That's the point of me showing you this. Here again, we have the midnight time frame, the opening price here. Okay, we don't care about the move lower. We want to be above the opening price, much in the same capacity here. We have the opening price here at the vertical line that's white here. We want to be selling above that price. It has to be above that price, or we ain't selling. That's the filter, okay? You're selling above the opening price here. Here's the rally up. Boom, you sell it, okay? Here is the opening price. Very modest little move above it. Doesn't matter. It's all you need. Sell it. Down move. You have optimal trade entry in here. You could have traded this one here and even taken profits at the old low. You could have done 15, 20 pips. Okay, but then it reversed and traded higher, came back and could have stopped you if you had your stop loss lowered in here. So this could have been a day where you could have made money and you could have lost it, or you could have just simply did nothing. It is a Friday. I don't like to trade Friday, so that kind of falls in a category in itself as well. So I like to trade predominantly Tuesday, Wednesdays, and Thursdays. If I made money on Tuesdays or Wednesdays, I don't do any trading the rest of the week. We have the scenario here. Here's midnight, and the price rallies up. We have old highs back in here, clean highs. So above that would be what? Stops. Look for a price to rally up to that and then reject. And you see that happening here. It took a little bit longer into the next day, but we have an optimal trade entry here. Trades back up to a bearish order block, the last bullish move up. Look at that low, draw that out in time. Comes right back to that price point. Also, notice that it's also taking out an old high here after midnight. See the rally up? It's taking out a stop, and it's ultimately also fulfilling an optimal trade entry. Pull your fib from this high down to that low, and I know a lot of you guys are saying, well, can you just do it, Michael? Can you just put the fib on here so I can just see it? Right here, optimal trade entry, boom. Where's the candle at here? That is 8:45 GMT. Surprised? That's the London Open kill zone. And then there's your move going lower. How many trades have we seen so far, guys? You catching enough pips? Just this day alone is 10, 20, 30, 40, 50 pips easily that one day. That's one week. That's it. I'm done. That's it. That's the whole week for me. I'm not worried about trading anymore. Okay. Now here's an optimal trade entry inside of the range that's already happened here. Now, why am I using it like this? Why am I going to pull a fib from here to here to get an optimal trade entry in here? Well, because we've taken out a previous day's low. When you see that, the chances of it coming all the way back up here is unlikely. It's unlikely, especially when you're in a down move, when it's heavily weighted to moving lower, longer term on a higher time frame basis, like a daily chart. You're really expecting too much of the market, okay? And with that understood, here's the midnight high, New York. Let me put this back on the low. There it is. And it goes right up to the sweet spot, right to the pip. And that's difficult to see, but do this on your own charts, okay? I'm just giving you the framework. But we had a low previous day, went down, blew through it, then came right back up, traded back inside this consolidation, and then down it goes. Notice that it also went up to this previous order block. This is a down, not down, it's an up candle. This is an up candle prior to the down move. If you use this little candle on here as well, same thing, it goes right down to that low, boop, and trades off. Okay, that's how precise you can get. But again, because you're doing what? You're focusing on being a bear. Why? Because institutional sponsorship suggests that they're long the dollar, which means there's going to be downward pressure on the cable, and we have institutional sponsorship because the averages are pointing lower on cable and they're opening up wide. So we don't want to buck that trend. We want to stay with that trend. We don't care about picking the bottoms. We don't care about that. Nobody wants to pick the bottom in ICT camp when we're in a bear market. Okay, we don't care about that. We're going to make all kinds of money in pips just going with the institutional sponsorship. Okay, just take all that wanting to be right out of it. Okay. All right, so we have another little rally in here. Okay, after the midnight time frame. Now you're saying, oh, wait a minute, that's not much. Right. It doesn't have to be much, okay? Look over here. What do you see? See this big move down? There's an institutional order block right in here. The bullish candle prior to the move lower, that's where the selling's going to be. So if you add that level right here, price trades back to that level, we would expect to see selling pressure. Add to that, okay, I'm going to darken this up and put a different color on it. Okay, we'll make it red. Okay, so there's your order block it traded into. Now add to it also the fib. See that high here? This downswing here. This is the parent price swing. And here's the low. Right there. Price comes right up to the sweet spot. Boom. When does it happen? After midnight. Right up in here. Bang. Okay. Sells off. Okay. Early that day didn't give you the classic 2 a.m. time frame, but on this day it occurs at 5:45. Wow, you're 15 minutes early. So you may have to catch the order block that was here trading up into the, this is still early Frankfurt, it's 6:30 GMT. Unless you were probably doing limit orders or just simply being up and awake and just watching it, you may not have, honestly, you may not have gotten a really good fill on this one. Or maybe even missed the move altogether, which is realistic. Okay, we have another one here. This is a real classic one. You have the high and low. Here's the move up after midnight. Rallies up. And you're probably already seeing it before I put it on the chart. Let's get this one off. Right up there, perfect optimal trade entry. Bam, 79%. Slam on, which is one we just discussed, and not surprisingly. Okay, here's one. Okay, and this is good that we're showing this. We have consolidation, the rally up. It takes out an old little high in here. Okay, that would be, honestly, this would be one that you could have traded with the easy for me to say, anticipating rather the move trading lower. Okay, and while it does trade lower, it does come back ultimately and rejects and trades higher. And you saw price come back rather explosively, and that's because we have a gap right here. Okay, whenever you have gaps in your chart, you want to kind of put blocks on that and extend them out in time, because price will come back up to these and fill that. Okay, much in the same vein it does here. And I actually traded this at 168.54 was my entry, and I just took 20 pips out. I didn't capture anything much more than that. But same thing happening here. I know you're probably saying, wait a minute, you just bought during a buy program, I mean a sell program. Yeah, because we have this gap in here, and it was just a small little intraday scalp, and I hadn't caught anything because there's a lot of personal things going on in my life, and I just wanted to be able to take something out for the week and be done, and that's what I did. So I have a birthday coming up this Friday on the big 42, so I'm trying to clear my schedule out. So that's the reason for the little bit of move in there. I haven't been able to be in front of the charts to capture anything in here, and honestly, there isn't anything in here that would be, something I could say my tools were able to deliver. So outside of that little minor move in here, there's been nothing for me to trade this week, and ultimately, I'm going to be focusing on just the fiber. I'm sorry, the cable, not the fiber anymore going forward when we do our live sessions, because I just want to be working on one pair. But we talked about the Power 3. We talked about Judas swings. I did not cover the Judas swing for New York, so let's do that now. All right, New York session typically sees an opening around 7 a.m. New York time. Okay, and you can use 12 GMT. Now, what I like to look at is I want to see what 6 a.m. Okay, 6 a.m., which is 11 GMT. I want to see that vertical line, and that'll give you your Judas swing parameter, okay, for the New York session. Now, let's go back and look at this example, and I'll tell you why I did what I did against the trend. We had a possible low formed here because we have really aggressive move formed right off of this price point here, and this is actually 7:45 GMT. Okay, price snaps up aggressively, and then it leaves a gap. All I wanted to do is see if it would come back up to this, and I was trying to play an optimal trade entry for a continuation going lower, but I was using the exit for the optimal trade entry pattern. In other words, I was looking at this. I was using this area here to exit my long. Price came down, filled the gap. But more importantly, I want you to look at what's going on. This is what I was trading off of. I was betting that this was the low of the day. Why? Because it was happening in London. London blew up real hard and then retraced, okay, and filled the gap. If there was no gap in here, I never would have took this trade, ever would have considered taking a trade. But because there was a gap, I went long in here with the expectation that I would see a further move higher. Why? The vertical line delineates 11 GMT or 6 a.m. New York time. If we're going to be a buyer, what do we like to see first in a Judas swing perspective? A down move. See what it's done? Here's the white line. This is New York Judas parameter, like the 5 GMT New York for London. We want to see a move down. Also, it fills in a gap and it trades into a previous order block. Rallies. See that? If you are looking at over here, you have your London open down day. Here is the New York session. So how do you get in sync with getting in New York? Well, you want to see a rally after 11 GMT or 6 a.m. That rally that occurs later on, that'll be the retracement inside of the existing daily range right up in here. 62% sell here, try to get back to the old low. Notice it doesn't do it here. Failed trade. Okay. I'm giving you what would happen, guys. I mean, I'm trying to keep it as real as I possibly can. You have a scenario here as well. You have the high coming off of in the London session, trades down. We want to see a rally after New York. Okay, after New York. Never gives it to you here, and you have to wait to the final day on London. Down move in here. You want to see a retracement of some sort. Okay, a retracement. This is, again, New York can be used for position trading. Guys that can't be up there in London, whatever. You would sell short here. You would have to ride out all through the next London session. So you can't move your stop. You can't do anything until the low is taken out. Once the low is taken out, then you start managing your trade and your stops. But until then, this is what you have to work with. But using the New York session, period separator at 11 GMT or 6 a.m. New York time, you want to see the rally. That rally is what sets you up for the continuation of the existing downtrend. Okay, framing your ideas with the London backdrop of what's going on in London and the overall trend being lower, but using the 6 a.m. New York or 11 GMT window, what that does afterwards, okay, is sets the framework up for your trade. Notice that we have the high formed in London here. We didn't get any kind of a rally on this day, so we couldn't do any kind of trade. So there was no opportunity there in New York. Yeah, nothing really to speak of there either. Again, this is that same day where it could have, I'll just classify it as a losing day. You would have lost money on that. The London session creates the high here. Here's New York at 6 a.m. We see a rally. The rally up to what? Old support broken becomes what? Resistance. Boom. Okay. High today in London, New York. You want to see what? A rally after 6 a.m. or 11 GMT. There's the rally into old resistance. Sell. You have a 5-minute optimal trade entry in here. You could have scaled into even with a smaller risk, but you're also playing up against this old low. Using the bodies of the candles right there. Okay, so you took out an old low, broke through it, came back, find it as support broken, turn resistance, and we had another trade through it, and it even blew through it just a little bit. See how nice of them? You know how nice they were about doing that. Right there is the highs that are equal. Remember I told you the best moves occur after the stop rate. Stops are going to be right above that or at that high. Boop, then down it goes. Okay, and this is in the doldrums of summer, guys. I mean, this is August. I mean, not August, July. July and August really are really the crummiest in terms of volatility. It's really nasty in terms of cleanness, in terms of where price can go perfectly and turn around. Um, that's why a lot of weight is mainly placed on the daily uh, and even weekly charts, really, because it'll give you the framework that you need to have for these large institutions to be behind your trades. So we basically looked at targeting, time of day, power three, Judas swings, how to apply it with both not only the New York session but the London session as well. We talked about the mapping aspect of putting the boxes on your chart, like we have here, this orange box, and what it means. Okay, and again, it's to bracket out a pocket of price action that the higher time frames are telling us the direction is most likely going to be. And in this case, we mapped out that it was going lower. So while we're in the intraday perspective, we are cognizant of the lower time frame, I'm sorry, the higher time frames moving lower. So we want to be more focused in on finding sell scenarios at specific times of the day with specific, reoccurring themes that would either be the optimal trade entry or the turtle soup. Um, it would be advantageous for you to study market profiling to a great degree. And I mean by that is markets move from consolidation to trend to reversal. Okay, there's only three things that can happen. The market's either going to go sideways in a range, or it's going to trend and break out, basically, or once it hits a resistance or support of greater measure, it'll reverse. There's the only three things that can happen with price. It's either going sideways, it's going up, or it's going down. And based on the three primary profiles, which is consolidation, which is range bound, okay, and you see that here. Here's consolidation, okay, reversal, trend, consolidation, right in here we have a reversal, old highs taken out, reversal, so we're in consolidation, reversal, trade lower, trending, consolidation, trending, reversal, consolidation, trending, reversal, consolidating, trending, consolidating, reversal, consolidating, trending, if you really want to call that. Now we're in consolidation again. Okay, so by understanding where we're at in the cycle, and there's no real repeating consolidation, trend, reversal. Okay, but it does go from consolidation to trend. That before you see a trend, there's a consolidation, and inside the consolidation is where all the smart money accumulation is being done, whether it be buying and selling. So hopefully this has been insightful to you guys. Obviously, understanding seasonal tendencies, and honestly, if you do a search on more research, and that's Moore. He has, in my opinion, the best seasonal tendency stuff there is. But you can pull up seasonal tendency graphs on everything from commodities to currencies and such. And oil, if you're trading crude oil, gold, silver, all that stuff. He has all that stuff. And if you just Google it on the internet, you can find all that stuff. But applying seasonal tendencies to the higher time frames as well kind of gets you in set for when there's a likely buy or sell program to come underway. A lot of my longer term analysis, where I've called major highs and lows, and where they're most likely going to form and then move into a new buying opportunity or selling opportunity, that's really hinged on the COT data and seasonal tendencies with higher level support and resistance. That's all it is, guys. That's really all it is. And by having these tools combined together, applying them will give you a huge edge that just the retail traders just simply don't even exist in terms of they don't even know this level of precision is available. Okay, and when we go into the fall and we trade through the winter months and early spring, the liquidity that is available then, you'll see, because we're going to be doing it live over my shoulder, and you'll see all these things happening in advance. We're setting up all the moves and what we anticipate seeing and all that stuff. When that happens, it will be a learning experience unlike any other for you. And I'm going to close my teaching out this year with this because obviously, as a mentor, I'm retiring, and 2015 will be the beginning of my life away from teaching. But my resources will be still available on the internet. Obviously, my email address, you can always reach me at ICT at theinnercircletrader.com, and as a backup email address, innercircletrader at gmail.com. And obviously, with everything that we've shared in here, this is just a massive, massive condensation, condensing rather of all the materials that I've been sharing over the last 4 years. There's much, much more that could be done in terms of reviewing, and I could go on and on and on, but it would take me another 4 years to do it. You know me. So we'll be doing a lot of application, which will help you get up to speed. But for those that are just now warmed up to my material, this kind of is like an overview, if you will, a real crash course of the things that we do and what we've been doing for the last 4 years. And you'll start to see everything I talk about in real time. It won't be made up. It'll be all hinged on the stuff that's been talked about for the last 4 years and documented on the internet. I mean, it's not like I, just start tweaking these things every day to make it work better. This is the stuff that's in my repertoire. It's stuff that I use to trade. It's stuff that other traders have been using for a long period of time that are familiar with my stuff and that are doing very well. So I'm going to close it here. This ends our series on what every new and or aspiring forex trader wants to know, recap or review. And now everything going forward will be real time, doing the drills, doing all the research projects and all the stuff that's necessary for you. But I'm condensing what you should be doing for 6 months into just 1 month. So by the time we're in the second week of September, we'll be in the swing of things with live trading with a live account. So with that, guys, I wish you good luck and good trading.